The investing world has changed more in the last 5 years than it did in the previous 3 decades. Markets have become more volatile, interest rates have skyrocketed after years of being near zero, inflation has returned in a big way, and geopolitical risks have risen across the globe. Amid all of this chaos, many investors are asking a simple but important question: does the classic 60/40 portfolio still work? For decades, financial experts treated the 60/40 strategy as the gold standard for long-term investors. 60% stocks for growth, 40% bonds for stability. It was simple, reliable, and historically delivered strong risk-adjusted returns. But today, with the world changing so fast, many are starting to wonder if this traditional portfolio has become outdated. In this video, we're going to break down everything you need to know so you can decide whether the 60/40 portfolio still makes sense for you in 2025 and beyond. Welcome back to Stock Predictor, your guide to smart, practical investing. Let's start with why the 60/40 portfolio became so popular in the first place. For decades, especially from the 1980s to around 2020, this strategy worked amazingly well. Stocks delivered strong long-term gains, and bonds provided steady income while reducing volatility. Most importantly, stocks and bonds usually moved in opposite directions. When stocks fell, bonds tended to rise. This negative correlation is what made the 60/40 such a powerful risk management tool. If stocks were down, bonds often softened the blow. That balance is exactly why so many pension funds, financial advisors, and long-term investors trusted it for so long. But the investing environment changed dramatically after 2020. For years, we lived in a world of extremely low interest rates. Bonds paid almost nothing, which meant the 40 part of the portfolio wasn't doing its job as well as it used to. Then came the inflation surge in 2021 and 2022. To fight high inflation, central banks raised interest rates aggressively. When interest rates rise, bond prices fall. As a result, stocks and bonds, both, fell sharply at the same time. That almost never happens, but in 2022 it happened in a big way. In fact, 2022 was one of the worst years in history for the 60/40 portfolio. Stocks tanked, bonds tanked, there was nowhere to hide. That event shook many investors' confidence in the strategy. So that brings us to the big question: is the 60/40 portfolio dead, or was 2022 just a rare exception? Let's break this down carefully. First, let's be clear, no investment strategy works perfectly every year. Even great strategies have periods of underperformance. But the real question is whether the core principles behind 60/40 are still valid. The answer depends on the market conditions going forward. One of the biggest factors influencing the 60/40 portfolio is interest rates. The good news is that interest rates today are much higher than they were for most of the last decade. That means bonds finally pay real income again. Instead of yielding 1% or less, many high-quality bonds now yield between 4 and 6%. This is a huge improvement. Higher bond yields mean that the 40 side of the portfolio is no longer dead weight. It provides income, diversification, and stability, just like it was originally meant to. Another important point is inflation. For the 60/40 portfolio to work, inflation must remain under control. When inflation is high, both stocks and bonds struggle. But today, inflation has cooled significantly compared to its peak in 2022. It's not perfect, but it's far more manageable. If inflation continues trending down, that's very good for the 60/40 strategy. However, we also have to talk about the risks. One major risk is that the correlation between stocks and bonds could stay positive instead of returning to negative. If bonds and stocks keep moving in the same direction, the protective effect of the 60/40 breaks down. Much of the strategy's power comes from the two asset classes offsetting each other. Another risk is that interest rates could rise again. If that happens, bond prices could fall, hurting the portfolio. Also, some investors argue that today's markets are simply too volatile and unpredictable for a traditional approach. They point to geopolitical tensions, rapid technological changes, and economic uncertainty. These concerns are real and worth considering. So, with all that said, does the 60/40 still work today? The most honest answer is yes, but with some adjustments. The classic 60/40 is not dead. It still offers diversification, simplicity, and long-term results. But it may not be the perfect fit for every investor or every environment. Instead of blindly following the traditional 60/40 formula, it makes more sense today to customize the strategy. One way to adjust the 60/40 is by diversifying your bond allocation. Instead of sticking only to U.S. Treasuries, consider adding investment-grade corporate bonds, short-term bonds, or even Treasury inflation-protected securities, also known as TIPS. These provide different types of protection and can improve your portfolio's resilience. Another adjustment is to diversify the stock portion beyond traditional large-cap companies. Consider including international equities, emerging markets, or even small-cap stocks. This broadens your exposure and reduces concentration risk. Another idea is modernizing the strategy by adding alternative investments. Many investors today include assets like real estate investment trusts, commodities, or even high-quality dividend stocks as substitutes for part of the bond allocation. These alternatives can help protect against inflation and market volatility in ways traditional bonds can't. Some investors also include a small percentage of cash or short-term treasury bills. With today's higher interest rates, cash can earn meaningful returns without taking much risk. This can smooth out volatility and improve stability. Now, let's talk about the most important part, the role of the 60/40 portfolio in real life. For decades, the 60/40 strategy has been the foundation of retirement planning. It provides growth through stocks and stability through bonds. The strategy isn't designed to beat the market during bull runs. Instead, it's designed to deliver solid long-term returns while minimizing large losses. For many everyday investors, that's a perfect match for their goals. You don't need to time the market. You don't need to pick winning stocks. You don't need to be glued to financial news every day. The 60/40 portfolio is simple enough for beginners and powerful enough for professionals. But here's the key. The 60/40 portfolio is not a magic formula. It's a framework. You can adjust it based on your age, risk tolerance, and financial goals. Younger investors who want more growth might choose 70/30 or even 80/20. Retirees might use 50/50 or 40/60 for more stability. The point is, not the exact numbers, but the balance between risk and protection. The reason 60/40 has lasted so long is because the idea of diversification will never go out of style. Let's take a moment to look at what experts are saying. Many major financial institutions, including Vanguard, BlackRock, and J.P. Morgan, still believe the 60/40 portfolio is effective for long-term investors. They argue that the poor performance in 2022 was a rare event driven by extraordinary circumstances, not a sign that the strategy is broken. They also highlight that bond yields are now much higher, meaning fixed income is finally useful again. In fact, many forecasts suggest the 60/40 portfolio could perform better over the next decade than it did in the previous one. But there are critics, too. Some argue that the world has changed permanently. They say that massive government debt, unpredictable inflation, and geopolitical instability make stocks and bonds more correlated than before. They believe the future requires a more flexible approach. The truth probably lies somewhere in the middle. You don't have to choose between sticking rigidly to the old way or abandoning it completely. The smart approach is to understand the logic behind the 60/40 and adapt it to today's environment. So now let's answer the question directly. Does the 60/40 portfolio still work? Yes, it absolutely can still work. But it works best when you treat it as a guide, not a rule. Today's market requires flexibility, awareness, and the willingness to adjust your strategy as conditions change. If you want a simple, long-term portfolio that balances growth and stability, the 60/40 framework remains one of the best starting points. It's proven, accessible, and time-tested. But if you want to maximize resilience in today's unpredictable world, consider modernizing the approach by diversifying your bonds, adding alternatives, or adjusting your stock exposure. One thing is clear. The core idea behind the 60/40, balancing risk and return, is just as powerful today as it was decades ago. Markets will always change, but smart investing principles stay timeless. Build a portfolio that reflects your goals, your risk tolerance, and today's economic landscape. If you do that, you'll be ahead of most investors out there. Thanks for watching Stock Predictor. If you found this breakdown helpful, make sure you like the video, subscribe to the channel, and share it with someone who's wondering how to build their long-term investment strategy. Until next time, invest smart, stay informed, and keep growing.